Good afternoon and welcome to the River UK Microcap Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to Chairman John Blowers. Good afternoon to you.
Hi, Alex, and thank you for that. And good afternoon, everybody. We felt this was a great medium today to talk about the regulatory news announcement we made on Monday, and thought that maybe a little bit of a narrative from me as chairman of your board would be handy, and then George obviously to go and flesh out as our portfolio manager some of the details and reasoning behind I suppose the board's optimism. But I wanted to just explain in probably slightly less RNS-y way what we're up to and how we are responding to a few sort of inquiries, I think, from shareholders who were pointing out that the River UK Microcap Trust has had a sort of stubborn and persistently high discount level, and it's also involved in probably one of the more volatile areas of the market in terms of very small microcap companies. So the board's been looking at this for a considerable amount of time. And looking at all the levers we can really pull to work on that discount level and how we can reduce that. That's in everybody's interest. Shareholders, we're shareholders, and obviously you're probably listening as a shareholder as well, or a potential shareholder. So we looked at the levers that we could pull, and really that sort of encompassed in the regulatory announcement. There are three things really. One is not necessarily mentioned in the announcement, but the first thing we wanted to do was introduce this idea that if in the 3-year period from now we cannot generate another capital redemption, we've done 5 in the history of the trust over the last 10-11 years, returning in fact more than has been invested in the trust, but we haven't seen one for a while. We certainly haven't seen one during my tenure as chairman and board member as I joined in 2022. So what can we do to get some capital redemptions, and how can we bring that discount down? So we looked at various mechanisms, spoke to a lot of people, shareholders included, and we think that what we're trying to do is identify whether we got a cyclical or a structural problem. Is investing in microcaps the problem? Is that broken now? We don't think so. But is it just a very long cycle that we're embarked on at the moment? Now, we already see signs. You look at the share price now of, the share price coming back up and growing pretty quickly. So that's good to see early stages of that cycle beginning to open up again now. So basically what we've done is we've said, look, in 3 years, if we can't pay a redemption out to our investors, then we should look at winding the fund up. If they can't get that discount down, then obviously there's more value to shareholders as a net asset value sale than maintaining it at a sort of 18-20% discount. So that's one thing we're doing. We want to keep that very simple. We don't think it'll happen at all. We have, absolute confidence in that. But the other things that we can do is share buybacks. We've never done or needed to do share buybacks before. So we're going to see if that can get a downward trajectory on the discount level of the trust. It's good to see that even after the announcement that discount level is already down sort of 4 or 5% to sort of 13%, and we'd like to see that lowering down. So from now on, you'll start seeing share buybacks in the market. And the third thing we're doing is we've made a further commitment to marketing. We've got some good marketing skills on the board and within River as well. So we've sort of clubbed that together and made a better impact in marketing. In fact, got some campaigns running now, to try and drive up some more retail interest there. So that's kind of the things that we are doing. I think we spoke to shareholders about, not every single shareholder, but as many as we could lay our hands on, to ask what they thought about this plan. And I think there was a very strong support for it. So, and I know George and the people at Singers have been out there speaking to shareholders, and I've spoken to one or two. I think they're pretty confident that this is the right pragmatic approach to take. And so, without further ado, if that's not coming out as clear, then we've got a Q&A at the end of this session. But I think it'd be good for George to take over the reins and explain where we are and where we're going.
Thanks, John. So John has I think touched on the important points there, and I think this challenge over the last few years about the cycle and people's optimism or otherwise for the very bottom end of UK listed companies is quite an important one. And so, we've at times over the last few years gone out and tried to look for new shareholders and gain kind of traction, and it's been very difficult. There hasn't been a lot of interest, and so I think the cycle is an important place to start. And so this is a chart which I hope will add some context to where we are in the UK small cap cycle. So this shows the total return of the small cap benchmarks, the Numis Smaller Companies Plus AIM Index, the bottom 10% of UK listed companies, our benchmark. As a reminder, we actually invest in the bottom 7 or 8% of that benchmark, but that's the kind of common small cap benchmark. Shows that relative to the wider UK market, also total return for different cycles over the last 30, 35 years. And so the red line is the current cycle that we are in, that started in September 2021, which was at the end of a very long bull market in smaller companies that had started coming out of the recovery from the GFC. And so I think there's a couple of points on here that are quite remarkable. The first is that the duration of this cycle is already very long. So we don't know where the ultimate low is going to be. So these cycles we've shown from the beginning of the downtrend until they recover to neutrality with where they were before. You can see the cycle from 94 into 2000 was a very, very long cycle, so approaching 10 years. I would probably say there were actually kind of two cycles in here. So you had a kind of 2-year down cycle and up cycle. It didn't get quite back to par, and then you had a cycle from 96 into 2001. But anyway, it's probably the most equivalent cycle anyway, particularly in terms of if you look at large versus small performance in the market. It's the one that kind of rhymes the most with the cycle in at the moment. You can see the yellow is the financial crisis. So very steep dive, relative underperformance of smaller companies got similar to where we've been recently, then very aggressive recovery, and then a kind of longer drawn out recovery. And all the other cycles have been shorter in terms of from peak to trough and back to neutral again than where we are today. So we're just trying to show that we are in a extreme bear market for UK smaller companies' performance. We don't think it's structural, but there are obviously sensible arguments out there for why it can be. That's typical in cycles. The final point to make is that this is not unique to the UK. We've seen similar cycles: US, Europe, Japan, China. Most markets have shown underperformance for smaller companies over the last 4 or 5 years. So that's the backdrop for where we are in the cycle. This shows, and John also mentioned our capital return. So we made 2 capital returns. The last 2 capital returns we made were in 2021, February or March, and then April or May. We turned in total 35 million. So the last of those was kind of towards the beginning of this chart. We actually got quite close to delivering another one. You can see the high point on this chart is our NAV at about 330 or 340. And we were quite close to being in a position where we could have announced another capital return, i.e. our NAV, our net asset value was approaching or at 110 million. We've then experienced this very long, painful downtrend in smaller companies' performance. We underperformed the market. We're very small. We're longer duration. There's been greater underperformance in the bottom end of that market. And then we've been through this very slow, long, you could call it a rebuild, or you could call it kind of bouncing along the bottom for quite a long time. And then the bottom part of this chart is the discount. And I think the board, our advisors, all got into a position where we feel as though the market thinks that there's a persistent discount. And so if we're trading at an 18 or 19% discount, actually that's just 3 or 4 percentage points wider than our average discount. And so that's what we trade around. Whereas we would look to peers and the wider benchmark and say, well, we should be trading on a much narrower discount. And the point to add to that would be, well, two. One, we think that we've proved our right to exist as a trust. We think we have a role to play in looking for alpha right down at the bottom end of the market. We've also always said that we will only ever return capital to shareholders. We're never going to be issuing new equity. And so, an additional reason for why we think we shouldn't be trading at a discount. We don't have any unlisted companies in our NAV. It's a daily NAV, so we there's no view to undermine what we believe is a very transparent NAV as well. And so, particularly recently, and I'd say 1 year or even 2 years, we've delivered strong absolute and relative performance. And yet this persistent NAV discount has remained. And so what has been put through, and what you'll have read in the RNS and what John's just mentioned, is a framework for us to build over the next 3 years to rebuild interest in the trust, to remove that persistent discount, with a view that if we're wrong, and it is a structural weakness in the very small listed companies, then a vote will be had to wind up the company that will be recommended by the board, and we will return shareholders capital. I've just got 2 more charts, and then we'll pass over to Q&A. So a bit of a busy slide, this one, but what it shows is that we've had 11 what I'd call trading periods. 9 of those are financial years. We IPO'd in December, so our first financial period was 10 months from December to the following September. And the most recent one is obviously from the beginning of our current financial year until the end of July. So the very top line of this shows our NAV performance. And you can see that in most of those periods, we've delivered positive NAV performance. I'll come back to the block in the middle, but down at the kind of 3 from the bottom is our relative performance to the Numis small cap benchmarks. That's Numis small cap plus AIM, bottom 10% of listed companies, and our quartile ranking versus our peers. So our relative performance versus the benchmark, and our performance versus peers. And again, you can see in 9 of those periods, we've outperformed the market, admittedly only by 1% in the year to 23 and the year to 24, so very marginal outperformance. But nevertheless, 9 out of 11 of those financial periods we've outperformed, and that's also true if you benchmark us against AIM. And AIM's been one of the problems recently. AIM, there has been very little price recovery in AIM, partly given the changes, partly given the composition of AIM. The final line I'm going to draw you to is the small cap premium. So we are very geared to the outperformance of smaller companies. We're very geared to the concept that portfolio managers are looking for a bit more alpha, a bit more risk, a bit more growth, and they go down to the bottom end of their market to pick up that kind of extra liquidity risk. And that doesn't exist when you've got a negative small cap premium. Actually, smaller companies are underperforming larger companies. It is not the norm, but there have been times where you do get a persistent negative small cap premium. The small cap premium is cyclical, but it is typically positive. What we've had in the last 4 years is either a neutral, negative, or deeply negative small cap premium. And actually, in those periods, we've still delivered, certainly in the last 3 financial periods, okay performance. The year ahead of the year prior to that was a very tough year performance, but followed several good years for performance. So the point just to make here is if the small cap market is turning and we do see positive small cap performance going forwards, then we think there is every chance that we deliver good NAV performance, good relative NAV performance, and also strong performance versus our peers. Which brings me on to the last point, which is the bridge between, I guess, where we are today and what we need to deliver to secure the kind of continued operations of the trust and us not going into wind down. So what we've said is June 2028, we need to have returned 10 million of capital or be in a position to return 10 million of capital. So we need an NAV of 110 million. To do that, we need to deliver an NAV CAGR of about 11% per annum. The calculation on the right-hand side here is the IRR we've delivered when you take into account all of the capital returns that we've provided over the years and the capital that we raised through IPO and a subsequent placing. So despite where we are in the cycle, which we think is relatively close to the bottom, impossible to be definitive about that, but potentially past the bottom of the cycle, we've delivered close to a 13% IRR. We need to deliver an 11% NAV CAGR going forwards to get to 110 million. And then the final nuance on that is so that there isn't a conflict for the board to commit capital to buybacks or to try and get to that 110 million target. Any capital that is returned through buybacks will be deducted from the 110. So for argument's sake, if we return 2 million of capital through buybacks, the target for end of June 2028 would be 108. Clearly, that would be the same NAV CAGR. We're just looking at it on a total returns basis. So I'll leave it there and pass over to Lucy for any Q&A.
Thanks, John and George. John, it looks like you might be in luck. Most of the questions are for George, so I will kick off. Are there any structural or governance changes under consideration that could help re-rate the share price to closer to NAV? I think that's probably one for you, George.
Structural or governance for the micro cap company would probably be more for John, but I would so maybe John leads on that, and I can come in as well with some thoughts.
Yeah, I mean, it's an interesting one. I think we are certainly not a board that meets 4 times a year and sort of have a good lunch afterwards. We have been working very hard on costs and looking very closely at governance. We stick obviously religiously to AIC guidelines. So I think we've kind of exhausted all avenues that we can tackle this issue, apart from the 3 that we're putting on the table this week. So I think the answer, probably is a quick answer, is not really. Nothing that will have an impact like what we've proposed.
Okay, thanks. And if a buyback fails to materially impact the discount, would the company consider increasing the scale of the program or making it permanent? Another one for you, John.
Yeah, I think as we haven't done share backs before, we should be watching this very closely. So yeah, it's right to call it sort of slightly experimental. If and plenty of other companies, not just investment companies, use buyback mechanisms now. If it's having a very positive effect, but we need to keep doing it to maintain a steady discount or at a level we think is right, then I think we might persist with it. Yes.
The only point I'd add on the buybacks is one of the main criticisms of buybacks, particularly in small investment trusts, is that you buy yourself back to kind of being too small. We have a commitment to return capital and not be too large anyway. And so, yeah, there's a balance there between obviously where we sit today, the opportunities we can see in the market, committing capital to them and having a buyback. And there's got to be a balance between those two things. But if things go the way we hope and we expect them to go, we're going to return capital to shareholders anyway. And so to do that when the shares are out of favour, trading at a wider discount than the board and the advisors think is sensible and is wider than peers, then that's accretive to all shareholders. yeah, John's absolutely right. It's not been done before, and we need to see what the effect is, and it needs to be balanced between the opportunities we've got to grow shareholder value through investments.
Thanks, George. And can you give our audience an idea of what liquidation expenses there would be for the portfolio if it was to wind up?
I mean, it's very theoretical, isn't it? It's pretty difficult to tell. It would depend, I guess, primarily on how confidential we were going about that. I mean, we very rarely trade outside the spread on the companies that we own. But if there was a public declaration that we were winding up, then you'd expect people to wait for our stock. I think, that's something the board needs to think about between now and June 2028. And rightly, if we're miles away from delivering the NAV CAGR that we have committed to in, say, 2 years' time, then perhaps there's a conversation to be had where we should be very careful about how we're committing new capital and how we're thinking about the liquidity profile of the investment trust. But I think the time frame that we've gone for, 3 years, is sensible. It allows us to continue to commit capital within the trust where we're trying to exploit the liquidity premium, which at the moment we would argue is high, i.e. there's money to be made, returns to be realised from investing in illiquidity. But the balance of that is that, there is quite an illiquid list of companies underneath. So I don't have a number. I don't think it would be right to have a guess without an informed number.
No, you're dead right, George. There's so many so many variables that you can't possibly see 3 years ahead. So I think it's not a good idea to theorise. Plus, we just don't believe that will happen. So there we go.
And it's. I mean, just thinking about it on the top of my head, it's a huge spread. We've got companies in the trust that we've owned since they were micro caps. They're now, very well established small caps. We could sell them in a matter of days within the spread. There are other companies where we own big stakes, and they're earlier on in that kind of life cycle, earlier on in their kind of acceleration of growth, and they would be harder to sell. But but impossible to put a number on this stage.
Okay, thanks. And then moving away a little bit from the redemption questions and some questions more about the portfolio itself. We have a question around holding private companies, and given the number of listed companies that are delisting, have you been a forced seller, or are you able to stay invested and wait for valuations to improve?
So look, within the prospectus, we have the ability to hold unlisted companies. I don't believe we've ever used that capability. My kind of first point would be, if we did need to protect value, that's not something we're averse to doing. If we did need to protect value, then we could use that. We have actually had an example recently, which I raised with the board a few months ago, where an AIM-listed company moved to NASDAQ. They then delisted their AIM list. And so we own a NASDAQ-listed company, which was AIM-listed. Now, we're not adding more capital to that because we're specifically a UK micro-cap investment trust. But we are trying to protect our value there and what we believe is a very depressed share price. And so we will always be, I think, pragmatic about that. But I'll caveat that by saying that certainly investing outright in unlisted companies is a different skill set, and that's not one that we have on our team. And therefore, there is a bit of a grey area between holding on to stakes that become unlisted. And there is different skills required to protect your stake in those instances. So I hope it's not something that we need to rely on, but we do have the ability to do it if we need to.
Okay, thanks. And along the same track, but slightly different, do you see takeovers in the portfolio ultimately as a route to raise sufficient cash for future capital repayments?
We haven't historically. I mean, we've had a lot of takeouts recently. I think we've had certainly 4, if not 5, Reynolds Science and Sport, Aquis, Windward, and I think there's one other that have been since the start of this financial year, so since the 30th September. I think they come up to about 20% of the NAV. So there has been a lot of activity. Historically, that's not how we've raised capital for capital returns. The last two, and one of the absolutely brilliant parts of our capital redemption mechanism is that it's pro-cyclical. So we were raising money from companies in 2021 that were well bid, well, certainly more expensive than they would be today, but arguably, at a high point on their ratings. There was a lot of enthusiasm for UK small caps, UK micro caps. We were harvesting quite easily capital from those names. Why it's more appropriate to us than a kind of fixed annual capital redemption is that we would have been forced over the last few years to raise capital in a market where it's, one, very difficult to do, and two, you haven't necessarily wanted to raise capital because the investment opportunities are significant. So I think the pro-cyclicality of our capital redemption mechanism has been very good. And if I just come back to the IRR, so the 12.7% we've delivered since inception. So that's cash on cash returns after all fees to shareholders. So it takes the NAV as at the end of July, all of the capital that's been returned to shareholders and the original capital in. So it's a money on money after fees IRR, and that compares to about 7% total return for the all share per annum. It compares to about 5.5% per annum return for small caps, and I think 3 or 4% total return per annum for AIM. So we've massively, and we're 80 or 90% invested in AIM. We've massively outperformed the performance of AIM. We've outperformed the performance of UK all share and UK small caps. And part of the reason is alpha. Part of the reason is that we've returned capital pro-cyclically at market highs. And if you look back at the timings of these returns, 2017, 2018, good time to return capital, 2021, good time to return capital. So the natural break in the portfolio of taking capital out of the market when markets are high, and so our NAV's gone through that threshold, has worked very well, and it's supported that I think very impressive IRR. Now, there's an argument to say our IRR should be a bit better because we're taking on a lot of illiquidity risk, but we've got a 5 or 6% premium to the all share. That's probably about right. If you did that IRR calculation in September 2021, which was the end of that small cap cycle, it was about 20% per annum.
Okay, thanks. We've got a query around the bid offer spread and it being obstructive to liquidity. Is there anything that we can do, or our advisors, brokers can be more supportive of to bring that in?
I mean, this is a source of much frustration at board meetings, actually, and Lucy and George will be aware of that spilling out and aiming at singers as well. We are putting a lot of pressure on brokers to adjust that, improve that spread. It is wide, and we'd like it to be a lot tighter. So that's going along in the background as well.
We've got a fairly specific question here on tax, which you may not be able to answer, George, but let's give it a bash. So listed unit trusts and investment trusts are exempt from tax on chargeable gains in the UK. If the government removed the exemption, how would you react, and how much tax would you have to pay?
I will defer to not knowing the answer to that, but the one thing I would flag is we are Guernsey incorporated, so I'm not sure we fall under that tax jurisdiction, but I am not a tax expert, so please don't quote me or rely on what I've just said.
Yeah, me neither, but I mean, that's something we can find out pretty quickly for you, Patrick D, and maybe Lucy, we can circle back to him in the fullness of time when we get the answer.
No problem. And just some final questions around the portfolio management and your process, George. Could you share with the group your stock selection process, how often you meet companies and if it's virtual, and at what stage you meet the companies and if that is the make or break point of investing?
So the idea generation process is quite in depth. So we think about investing in companies at different stages of the company life cycle. So we talk about growth companies, quality companies, and recovery companies. And we split recovery companies between recovery, margin recovery, and asset-backed recovery. And our idea generation, we screen for companies that have attributes that drive future shareholder returns in each of those categories. So if you like, we've got 4 screens. Each of those screens is looking at shareholder value creation, valuation, and earnings momentum, technical momentum. So we're screening, there's about 450 companies between a market cap of 20, free flow market cap of 20 and 100. So we're screening that, and between myself and the 2 other PMs, Anna and Mayan, we're reviewing high-scoring names and having a look as if those want to come into the portfolio. We are also open-minded to, we're not totally cut off from the outside world. We're listening to what's going on in the market and what companies are saying. So the research process starts with that screen. We then build models, very category specific. So if we're looking at a growth company, and that's typical for microcaps, about half of the portfolios in growth companies, the way we think about shareholder value creation, valuation, and timing is specific to that category. And typically we won't buy before we've met the management team. That isn't a hard and fast rule. And it's the management meeting is almost always at the end of that process. We go in with a view, with a hypothesis to test and challenge. That meeting tends to be very focused on kind of company fundamentals. What's their kind of sustainable advantage versus peers? What's the margin recovery opportunity in an example of a recovery stock? And look, liquidity is a part of this, is exploiting liquidity. So we also react to liquidity opportunities or spend quite a lot of time trying to find liquidity opportunities to get into companies. And so that is where it would be a bit different to a kind of larger multi-cap fund. We are constrained. There's not always an opportunity to buy in. And sometimes we have to be patient. Sometimes we have to be early, and we know that there might be a negative update coming, but we get in before that to start building a position. So hopefully that provides a bit of insight. Relatively concentrated portfolio, about 35 stocks, typically half of the portfolio in the top 10. We're cautious leverage. We don't tend to invest in too many companies that are net debt. And we have a bit of spread between about 50% in growth, 25% in quality, and 25% in recovery.
Perfect. I think that is everything for today. If anyone listening has any additional questions, please do reach out. You can get us at investment.companies@river.global, which is hopefully quite straightforward. George, John, any closing remarks?
None from me, but again, speak to Lucy if there's anything that wasn't absolutely crystal clear, and you don't want to ask in front of everyone else, then please, just get in touch with us. We don't bite. We're very helpful.
Fantastic. John, George, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of River UK Microcap Limited, we would like to thank you for attending today's presentation, and good afternoon to you all.